Hola, hola, hola. Hola. Hola, 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 hola. Hola. Lo dejo en inglés. Vale.
Este evento contará con una plataforma dedicada a la transmisión en vivo. Entrando a la página web del evento, eventos.flar.net, podrá encontrar los auditorios de las sesiones en vivo. Una vez en el auditorio, podrá ver la sesión en vivo, participar en el chat y ver información de la sesión, así como la biografía de los conferencistas. Si tiene dudas sobre la usabilidad de la plataforma, puede escribir un correo a comunicaciones@flar.net.
Well, good morning, afternoon, evening to all of you, and many thanks once again for your participation. We're delighted to have Campbell Harvey as our distinguished speaker to kick off the second day of our 35th annual conference for official institutions. Well, I can tell you that this is a subject of great personal interest to me, so I can really wait to get started. But first, do allow me to introduce our very special guest. Campbell Harvey is a Canadian economist. He was the first to show that inverted yield curves predict recessions. He also was the first to argue that half of the empirical research in finance is false, and has also published important studies in behavioral finance and corporate finance. He's professor of finance at Duke University's Fuqua School of Business and a research associate at the National Bureau of Economic Research in Cambridge, Massachusetts. In 2016, he was president of the American Finance Association. Professor Harvey earned his doctorate in business finance from the University of Chicago. He has taught at the Stockholm School of Economics, the Helsinki School of Economics, and the University of Chicago's Booth School of Business. He also has served as a visiting scholar at the Federal Reserve System's Board of Governors, and he is an American Finance Association Fellow. Harvey received the Journal of Portfolio Management's Best Papers Award in 2016 and 2015 for his research on distinguishing luck from skill. He has also received 8 Graham Dodd Awards scrolls from the CFA Institute for Excellence in Financial Writing, and has published over 150 scholarly articles on investment finance, emerging markets, corporate and behavioral finance, financial econometrics, and computer science. From 2006 to 2012, Harvey was the editor of the Journal of Finance, the leading scientific journal in his field, and one of the most prestigious journals in the economic profession. Professor Harvey has taught innovation and crypto ventures at Duke University for the past 7 years. The course is primarily concerned with blockchain technology and decentralized finance. He also teaches technology-driven business transformation and international finance, and also has a Coursera course called Blockchain Business Models. Today, we will be talking about his book, DeFi and the Future of Finance, which just came off the press as it was released a couple months ago in precisely the fall of 2021. So good morning, Cam, and welcome to our conference.
Thank you for inviting me, and I'm looking forward to our chat.
Well, wonderful. Cam, as I mentioned, it is a pleasure to have you with us. We are extremely grateful and honored, and I can tell you that after reading your book, I find it extremely exciting, but both in a positive and also in a somehow anxious way. So I'm really thrilled to have this opportunity to discuss it with you. So Cam, you clearly are an established figure in the fields of economics and finance, and for a large part of your career, well, you're recognized for many very important innovations, mostly in economics and investment-related subjects. But I am curious to hear from you, how did you get to become interested in the crypto space?
So much of my career, my research is about positioning for the future. So you mentioned my inverted yield curve dissertation showing that forecasts future economic growth and recessions in particular. And it's done really well out of sample since my dissertation, in that it got all of the recessions in advance. In other parts of my research, also the same thing, where you're looking at various information in the economy that helps you dynamically adjust the positioning of your portfolio for the future. So finance really is all about the future. There's other fields like accounting, which is very valuable, but it's about understanding where you are today and the past. That's, again, that's key information, but finance is very much looking forward. So a stock, obviously, is just the value of cash flows in the future. So my story is kind of related to this in that after you mentioned that I was editor of the Journal of Finance, and this was 2006 to 2012, I went back to my international finance course in 2013 and decided, well, I'm not going to do the same material that I did 7 years ago. The world has changed. I want to update what I teach. And I've got a module on foreign exchange. And I decided, well, why don't I add material on cryptocurrency? That would be new. And I don't know that much about it. So I'm a curious person. And anything that's got the possibility of having an impact in the future, I want to investigate. And that's where I started. So I started with the Satoshi Nakamoto white paper that is from 2008. And I read that paper and I couldn't believe it. Like it was, wow, this is a paper, like I'm the editor of a scientific journal. We go through the peer review process. It's very painful. And a very small fraction of papers are published, maybe 5% of them, in the journal I edited. This is not like that. It is a white paper that's on the internet. It's just sitting there. And we don't even know who the author is. It could be a he, a she, it could be a group of people, very mysterious, but I read the paper, then I read it again. And I'm thinking, well, this is a big idea, really big idea. And then I went down the so-called rabbit hole and started to learn about this space. And it is a very interesting space in that it is the confluence of well-established ideas. So in computer science, distributed systems, and cryptography, of course. There's also some game theory from economics and financial economics, of course. You put all this together, and that's what this white paper actually did. And you've got something that is really interesting and really challenges the traditional model of finance. And of course, if you know about this Satoshi Nakamoto white paper, it actually features a reference to the global financial crisis and the poor job that our banking regulators did in the crisis, the lead up to the crisis, where they let the large commercial banks basically act like hedge funds. And when the leverage was so high and something happens, you get wiped out. And what the solution was to bail them out. And I think at that point, that was a trigger for a lot of people that we need to rebuild the financial system. We need to rebuild it from scratch. And we're not going to do this in the usual method. So many of the people in the space had minimal knowledge of economics and finance, but they brought different tools, and it's an ongoing process. So I did this in 2013, and I did a lecture, a single lecture that was 2 hours long in my course. I was nervous because it was a little outside of my comfort zone. And the story goes, it's kind of interesting. And we all remember taking college classes. And at the top of the hour, you finish the lecture, you don't go 1 minute late, you don't go 2 minutes late, that's a disaster. At the top of the hour, people just leave. They just bolt. And I thought I was at the top of the hour. I finished my lecture, which was 2 hours, right? So it's a long lecture. And students just sat there. And I'm thinking, maybe I finished early? But no, it was on time. And then my second thought is, oh, this must have been just a horrible lecture. They're stunned that it was so bad. I bombed this lecture. But no, that wasn't the case either, because they came to the front and said, well, this is a transformational idea, that this should not be a lecture. This should be a whole course, a learning experience, maybe more than a course. And that really inspired me to dig deeper and deeper. And today I teach this course, which is largely decentralized finance. And you mentioned a Coursera. I actually have 4 Coursera's that are focused on decentralized finance, and they've just been launched within the last couple of weeks. So I'm definitely into this. And again, I think it's important to give my students a vision of the future. That's very important for their decisions in terms of how they're going to allocate their own human capital. And again, finance is about the future. This is a disruptive technology that challenges the current model. And I think it has a lot of promise in terms of what it can do.
Well, Cam, that's really fascinating. I wish I would have been there, but anyway, just being here, listening to you, it's really exhilarating. Let's see, we have a lot of ground to cover, and a couple of things. I would like, on the one hand, to cover some of the foundations of DeFi, because we have a heterogeneous group, and they may be in different places in the learning curve. But then also in our audience, a large portion is composed by central bank reserve managers and also from other areas. And there are a couple of use cases. Well, one, the particular implications of DeFi for central banking as we know it. And then also I would like to explore in some detail the use case for portfolio management in a DeFi world. But I mean, first things first, what is DeFi? How would you go about explaining that to our audience?
So it's basically a technology, and it's got many different aspects to it. Let me give you a simplified example, and that's a decentralized exchange, or we sometimes call it DEX. So I've got asset 1, and I'm looking to exchange it for asset 2. So the usual way I do that is I establish an account with my broker and go through that process, their bureaucracy and back office and things like that. So in decentralized finance, I actually send asset 1 to an algorithm. And this algorithm exists, for example, in the Ethereum blockchain. And then that algorithm sends me back asset 2. So I'm interacting with an algorithm. We call these algorithms smart contracts, but that's not really important. The algorithm I can use at any time, so 24/7. The algorithm, I can see the code behind it, so it's completely transparent. I can see the balances of asset 1 and asset 2, so that's transparent. And I've got a very good idea of the exchange rate between asset 1 and asset 2 that I will get. And indeed, I could put a bound on it that if I don't like it, then the transaction's canceled. So it's not too difficult to imagine in the future that we will be interacting with algorithms, and not just in finance. So we're already seeing that today. So this idea of decentralized exchange, where you cut out the broker, this is an algorithm. The algorithm doesn't care if you're buying or selling. It doesn't care who you are. It's just like a very efficient way to do exchange. And effectively, what it's doing is it's matching peers. So it's so-called peer-to-peer. Whereas if we interact with a traditional broker, that's not peer-to-peer. There's a middle person. And let me also emphasize, while I'm talking about decentralized exchange, that I'm not talking about Coinbase or Binance or Kraken. Those are centralized exchanges. Those are just brokers. So I sometimes call them C-DeFi, so C-E-D-E-F-I. So they're centralized institutions that deal with a lot of decentralized finance. So decentralized finance is not about those exchanges or brokers. It's about a way to match people individually. So the first aspect of DeFi is exchange, and it's done in a decentralized way. There's also savings and lending protocols. And again, what we would usually do, we go to the bank and deposit our money and get like a trivial, if any, rate of return on that. And we lose money in real terms because of the level of inflation today. With these protocols, you don't have all of the expenses. So you don't have the buildings. You don't have all of the employees, the back office, the money that you need to spend on computer security and stuff like that. It is completely absent. So when you take all of those costs out, it makes sense that the savings rate can be higher than in a commercial bank, and the borrowing rates, they can be lower. So you take a friction out of the system. So decentralized finance is also about savings and lending, done in a way, again, that it doesn't matter who you are. And it's also much deeper, of course. There are insurance applications, there's tokenization in general. So various assets could be tokenized in a blockchain and traded very efficiently. It's about payments. It goes very deep, but the key thing is that there's no central institution running any of this. It is literally a computer program that resides on a number of computers within, let's say, the Ethereum network, and you interact with that. So that's essentially what decentralized finance is.
Well, so many things you put in there. I don't know where to go, but one thing that you do mention in your book, and I did find it to be a really mind-blowing idea, is how you go about talking about the origins of money. Going back to the barter way that exchanges took place, and then how we are potentially or effectively coming in a full circle to barter without needing currencies at all in the future. And if you could expand a bit on that idea, I think it's really a transformational concept that you bring out in your book.
It was transformational to me because I'm trained in economics at the University of Chicago, and we do economic history. And we start with barter, right? That's the first kind of market exchange. And it was a horrible way to transact because you had to exactly match. That I've got two pigs and I want like a cow, and you need to find the exact match where the other person wants the two pigs and willing to give the cow. So very, very difficult to actually pull off. And that led to the rise of money as we know it. So money was used for transactions as a store of value, and market exchange became very, very efficient, but only to a certain degree. And if you look at the frictions today in terms of doing transactions, they are very large. So in the United States, it's just routine when you swipe a credit card to pay 3%. In other countries, it's more than 3%. I feature a wire transfer from one of the first Western Union wire transfers in my book from 1873. It's for $300, and the fee is $9, which is 3%. And at 150 years, and very little's changed. And just by the way, this has been attacked on the social media because somebody actually went out and tried to do a Western Union $300 transfer. and the fee was much more than $9. So this person argued things got actually worse than 150 years ago. But the point is that you've got all of these frictions, and what tokenization allows is to have a digital representation of various different things of value. So for example, I could have a token that is backed by US dollars. I could have a token that's backed by gold. I could have a token that's backed by IBM stock. So what DeFi actually does is it allows us to expand our concept of like money and value, where I go to the store and I want to buy some groceries, and then I open my wallet, which is my smartphone. And it's also, I call it a wallet, but it's also a bank. It's your bank, your personal bank. And then I've got various assets in my wallet, and I choose what I want to use. And maybe I choose gold. And maybe it's the case that the merchant or the grocery store, they don't want the gold, but it's completely seamless. So I exchange in the decentralized exchange. And again, the user has no idea what's going on here. I use my gold and it is exchanged for something that the merchant actually wants. Transaction goes through very quickly. Okay, so the full circle, when I say this, and I think actually the first sentence in my book, that what I mean by that is tokenization allows us to return to barter. That there's so many different ways that we can represent value very efficiently and actually use that as a substitute for traditional money. So a national currency, for example. So you've got these other options. And this is barter. So it's a different type of barter that is very efficient. So I do think that this is definitely something that the central banks have noticed. So I don't think they care as much about the price gyrations of Bitcoin or Elon Musk and his tweets about Dogecoin. I don't think they really care about that. What they do care about is that they've had a monopoly on on money, and they make a lot of money off of their monopoly on money, seigniorage. And all of a sudden, in a very efficient way, and just to be clear, more efficient than the current system. So the current system in the US to transfer money from one institution to another, that could take 2 to 5 days, and it might be rejected. So there might be an issue with it. All of this happens very quickly. So you've got another alternative that is a way to exchange value or a store of value that operates much more efficiently than what we've got today. So that is a real threat, I would say, definitely.
Well, so many fascinating things that you laid out in there, but and we'll follow up on that. But I did want to stop a bit before proceeding on that to talk about some foundational enablers to DeFi, and if you could explain a bit for some people, all they may know about crypto is just Bitcoin, and they may have heard of Ethereum or others, but they may not know the difference between one and the others. But then Ethereum, which is the example that you use in your book, it's really different and much more versatile than Bitcoin, and actually becomes, these features are the ones that become the enablers of DeFi. So if you could explain a bit for the audience to familiarize on why this is so important.
Yes. So Bitcoin was the first cryptocurrency and launched in 2009. and it's still the currency that holds the most value. And Ethereum was developed to essentially improve upon the Bitcoin blockchain. And there's a very specific improvement that's crucial for decentralized finance. So in Bitcoin, you can use Bitcoin as a transaction mechanism. And that was the original idea of Satoshi Nakamoto. So I can send you some Bitcoin quite easily, and you can send me some Bitcoin. So what Ethereum actually does is that it enriches the idea so that we can have a third way to send, and we can send funds not just to different people, but we can send funds to a smart contract that resides in the Ethereum blockchain. So it's a different address, and we're able to actually run a computer program in the Ethereum blockchain. You cannot do that today in the Bitcoin blockchain. So these computer programs are crucial for decentralized finance. It's something, as I said, that Ethereum has that Bitcoin doesn't. So if you think of the value proposition of Ethereum, it's a lot easier to think about, because we know, for example, Amazon, AWS, you can buy computing power from Amazon, and therefore AWS is valuable. Well, with Ethereum, it's the same thing, that I can deploy a contract in Ethereum and that can be run. So that's providing a service. And I gave an example earlier on of you send asset one to a contract, you get asset two back, a very simple decentralized exchange. But this is valuable to actually do. So it is a different value proposition, and almost all of decentralized finance is focused on Ethereum right now. There are Ethereum-like blockchains that you can do decentralized finance on, and they actually, many of them have improved upon Ethereum's ideas. So one thing that is certainly in the news these days is the mechanism whereby the transactions are approved and added to this ledger that exists on many different computers. And the original idea in Bitcoin was to use a proof that is very computationally expensive and very energy hungry. And Ethereum essentially has the same thing. So both of these technologies are environmentally reckless. So Bitcoin alone is using the electricity of the country of Argentina. Okay, so these competitors to Ethereum have actually figured out, well, we need to change that. We can use a different technology that's much more energy efficient. And Ethereum, in its version 2.0, which will likely be launched in 2022, will switch over. So that'll be very important, because when you've got that energy efficiency where you're not doing damage to the environment, like Ethereum is doing and Bitcoin especially, I think that's very important for the future of this technology. It also allows us to greatly scale the number of transactions we can do per second. But another part of your question is really important, because it's, well, how do I get involved in this? I've heard about it. Maybe you're listening to this talk, but what can I actually do? And there's so many like really basic things that could be done that are really interesting to do. But keep in the background in your head that this is really early in the technology. So we're less than 1% in. So there are some barriers to getting in. So my example of the grocery store, you're paying in gold, that's an example of the future, not necessarily today. So we're headed in that direction. And right now, the user experience is not great. But nevertheless, if you want to get involved, and my students in my course certainly are required to get involved in a small way. So things like a savings rate that you can get, let's say, 5 or 6%, which is really good compared to less than 1% in the US. And then people say, well, do I need to take a lot of risk for that by buying Ethereum or Bitcoin or something like that? And the answer is no. So you can actually exchange your currency for a so-called stable coin, and maybe it's linked to the US dollar, and then just deposit that in a DeFi protocol and earn 5%. And that is a small way to get in. So you don't bear the price gyrations of Ethereum. So the only volatility is the volatility of, let's say, the US dollar. So this is a small way to actually get in. Anybody can download a so-called MetaMask wallet. So it's just an add-on into, let's say, Chrome, and you can establish a wallet, really simple to do. Or you might want to set up an account with a broker, like a centralized broker. In the US, it would be Coinbase or Binance, just depending upon what's available. And one advantage of having the broker is you don't need to worry about losing your private key. And that's something we haven't talked about. And that's what makes this space really special, that your cryptocurrency is defined by your private key. If you lose your key, then you lose your cryptocurrency. So the private key is linked to an address where anybody can see. So I can send you to that address some cryptocurrency, but only you can spend it once I've sent it to you. And only you have the private key. So you don't need to worry about that stuff if you establish a brokerage account, or you can go directly without the brokerage into MetaMask. But again, this is early time, and the user interfaces are pretty crude at this point.
Well, it's funny that you mentioned the private key thing, because there are frequent news about people.
Es interesante.
Literally millions of dollars equivalent. So that's certainly gotta hurt.
Did you read this New York Times story? It's a great story where this programmer in San Francisco had some Bitcoin and was worried about losing the private keys. So and there's various ways that you can protect your private keys. So for example, you can put them on a USB drive that's not connected to the internet. You can literally print them out and just store a hard copy somewhere. There's many different ways, but this programmer decided, well, I'm going to use a hardware wallet. So it's a special device that's not connected to the internet, and it's got a single password. So that's all you need to remember, the single password. However, the programmer forgot the password. And to make things worse, you get 10 tries. If you miss 10 in a row, then the hardware self-destructs, and there's no way to recover any data. So this programmer's tried 8 and failed on 8. He has 2 more tries, and then everything is destroyed. In that wallet is $220 million of Bitcoin.
Gosh.
Yeah, so again, this is in my book, I talk about custody. This is a risk. So there's different ways that you can mitigate that risk. So you could use a custodian. That's one way to do that. There's also, you kind of worry about, well, what if the custodian is hacked into, I would lose my my cryptocurrency? Well, there's also custodians that actually custody only part of your key. So a third, let's say, and you have another third on your smartphone, another third on your desktop. So you need 2 out of 3 to reconstruct the key. And so if the custodian is hacked, the hacker can do nothing with the 1/3. If you lose your smartphone, it's no big deal because we can reconstitute. So there's many, again, this is early in the space. There's many different ways to mitigate that particular risk, but it is a different type of risk. We're not really used to thinking like this.
Okay, and talking about the 1% that you mentioned, and you did, you know, keep some inroads into that, but the specific use case for blockchain that we're talking about today is decentralized finance, but that's only the tip of the iceberg, isn't it? So what other use cases, or what's the broader case that you see going forward?
So for blockchain technology in general?
Well, yeah, the, you know, smart contracts and other, you know.
Yeah. So so my course, Innovation in Crypto Ventures, mainly focuses on decentralized finance, but we also talk about all of the other potential applications of this technology, of blockchain technology. And think of blockchain technology as a decentralized record of history that cannot be altered. So once it goes in, it's there forever. Okay, so this is a property called immutability, which is a foundational concept in blockchain technology. So there are so many applications of this technology, and we talk about some of them. Decentralized finance, or DeFi, is the lowest hanging fruit. So it's the most obvious one, but there's other ones that are really obvious. So for example, supply chain. So blockchain already is widely used in supply chain problems. And think of a world where you're in the grocery store, you see some lettuce, and it's got a QR on it. You scan the QR, and you know where that lettuce was grown, whether it's organic or not. You know the day that it was picked. You know every single stop on the supply chain, and you also know how long it's been on the shelf at the store. All of this enabled with blockchain technology. And it goes far deeper. You know, this is a simple example, but examples that are in use today, the container ships, all tracked in supply chain blockchain constructs. But it goes even beyond this. So think of something that is not really well done today, and that's identity. So blockchain technology is kind of a logical construct to basically have your identity, and it's easily verifiable, and nobody can edit your identity. So once it's there forever. A hacker, no way. A government, no. It's just not possible to do. So there are so many applications here. We talk about voting in my class, where you cast your vote and you've got instant results that are highly secure. So what we're really talking here is a transformation in many different industries, not just finance. The way that we do business in the future will be blockchain enabled. And when I say blockchain, we need to be careful here, because there's various different ways to implement blockchain. So I've already told you one way. So Bitcoin blockchain is just a peer-to-peer mechanism, whereas Ethereum is richer in that we've got, yes, the peer-to-peer, but also the peer-to-contract to peer. So various different blockchains have their own special features. It's not one technology. It's multiple technologies.
Okay. Well, time is flying. I'm having a great time, and so many things that I would like to talk with you. But as I mentioned, given our specific audience, there is this specific case within the DeFi use case, which is the current paradigm for investment in portfolios for financial assets. So that's something that I am charged with doing, and as many of the people in this call. So you know how that goes, and you're quite familiar with it. It's with the trading. It's all the market making, the price discovery. Then there is, very large opacity of the pool holders, liquidity considerations or illiquidity, very high liquidity for many assets. Then there is the bid-ask, the counterparty, the operational risk, brokers, custodians, correspondents, SWIFT, you name it. So I wonder if you could please explain, how a DeFi alternative would work for this specific use case.
So think about the future. We're just so used to using our commercial banks, our brokers, our stock exchanges, derivatives exchanges, and rely upon the central bank to bail us out when there's trouble. So what you need to do is to think beyond all of that. So think of a different model where the middle people are gone or greatly diminished role, and everything is decentralized. So that fundamentally changes the commercial banks' business models, and they are at great risk, and they know it. And I believe that most will survive with a different business model, but they are at great risk. Or the exchanges, all of this stuff that you mentioned, like bid-ask spread and things like that. This is all because there's a middle person, right? So you think about going to the bank and you want to, you need to have like 10 million euros at the end of November. You've got dollars, they make a quote to you, and then some of the customers to the bank, the same bank, they need to sell 10 million euros at the end of November for dollars. So they get quoted a different rate. And that's the spread the middle person actually makes. So think of a different story where you put those two together as peers and you eliminate that spread. That's a good thing. So it's a good thing for the buyer, it's a good thing for the seller. And that's really what we're talking about in the future. So for asset owners, this will be a great innovation. So if you're an asset owner, so if you're running a pension or something like that, this means reduced costs, very bluntly. And reduced costs are just the easiest way to generate extra returns. And even if these costs seem small, like a fraction of a percent, they compound. And often these funds have a very long horizon. But it's also just the way that we do trading. So think we had mutual funds and then a lower cost ETF is launched. Well, in the future, all of the stocks will be tokenized. And the ETFs will be like CTFs, like crypto funds. So basically crypto in that you've got a collection of different tokens in your fund. And yes, the ETF costs are lower than mutual fund costs, but these crypto funds will be even lower cost. And then there's also this possibility of having available to you assets that, while they might exist, are like really illiquid and very difficult to trade. So we've got this concept in DeFi called non-fungible tokens, or NFTs. And an NFT is a very special token that's linked to a particular asset. They initially were called deeds. So let's say a deed to some land or something like that. That's very specific to the land. So it would have its own token. So these NFTs live within the Ethereum blockchain, and it allows people to trade these assets that they wouldn't think of trading before in their portfolio, like a painting or a piece of music. That painting existed and the music existed, but it was so illiquid that you couldn't do anything with it. So this technology allows us to greatly expand the scope of our portfolios, and it allows us to become much more diversified, which is a good thing in finance. So for the asset owners, this is just an amazing technology that will allow opportunities, both in reducing costs and expanding the portfolio range of different assets that you can buy. All of that is really good for the asset owners. It's really good for consumers, right? So on many different dimensions, you get a real savings rate if you're a saver. You're banked. So 1.7 billion people in the world are unbanked. So this is a technology where everybody's banked if you've got a smartphone, and we're very close to that already. Kind of worldwide adoption of smartphones, worldwide internet, all this stuff. So this is a technology that allows us to grow. And my academic research points out that there's a direct link between reducing these financial frictions and economic growth. So if you reduce these frictions, you actually have the possibility of going on a different path. And we've been stuck, especially in the US, in Europe, in Japan, in this very slow growth phase. So this is a problem with the current system, and we've not addressed it. Our current commercial banking system is highly concentrated, and that concentration means that they can do it. They can keep the savings rate really low and the borrowing rates high, and they can exclude people. And the example I give in my book of a situation where it's not unbanked, it's underbanked. So think of a person with a bank account, an entrepreneur. They got a great idea, and they're very excited about the idea. It's going to generate 24% return on investment. They go to their bank and they say, well, I need some financing for this great idea. They present the idea. The banker loves it, says, this is a really good idea, but we're not going to lend you the money because we would prefer to deal with a larger client rather than 100 like you. But given that you're a customer of the bank and that you've got a credit card, we'll extend the credit limit on your card so you can actually take this loan out. But, and there's a big but here, the interest rate on the credit card debt is enormous. And the interest rate is so high that the project that looked really good is never pursued. And this project I described with the 24% growth, that is exactly the kind of project that we need to pursue in our economies. That is the kind of project that basically jolts us out of this slow growth mode and allows us to talk realistically about real GDP growing at 5 to 10%. That used to be, well, maybe China could get something like that. They can't anymore. We need to ask the question, well, why? And part of the answer is the financial frictions that exist today. So you can think of DeFi as reducing those frictions. You can think of DeFi as actually a technology of financial democracy, where everybody is the same. It is a technology of inclusion, where it doesn't matter if you're a small business person, entrepreneur, going to the bank. Traditionally, it's a problem. In decentralized finance, you're just a peer. And it doesn't matter how big you are, whether you're asking for a $1,000 loan or a $10 million loan. So yeah, so it's a lot of possibilities here.
Well, we could talk. We could have a whole session only on that topic, and but we're getting close to the end. We only have about 10 minutes, and we have some questions from the audience. And but I do want for you to tell us a bit about how you see the central banks playing in this new world. And at that respect, we have also a couple of questions. One talking about the need for fiat money. If you're talking about exchange stable coins to fiat money. Also, there is a question on how do you see this decision by El Salvador to adopt Bitcoin as a legal currency. Another question goes on the role of regulators in this environment, and that also relates to an important topic, which is the risk inherent in the system. So I know it is a whole lot to throw at you, but
yeah, I just wrote down about 7 different questions.
But probably at least in general, certainly central banks going forward, right. Certainly risk going forward. I would say that's probably the core.
Yeah, so let me talk about the CBDC, our central bank digital currency initiatives first. When these cryptos first arose, I remember the reaction of Ben Bernanke, then chair of the Federal Reserve. And he said, this is a good idea. And it seems that it reduces transactions costs. So I'm interested. And he's talking purely as an economist, because economists disagree upon almost everything. There's only a few things they are agreed upon. And one thing is that if you reduce frictions, that's a good thing. So they agree upon that. It's a good thing, as I said, for economic growth. It's a good thing for consumers in general. So that was the story. And then it was largely ignored by central banks because a lot of what was happening was just speculative. So it was people gambling on Bitcoin or some other cryptocurrency. And indeed, even today, most of the trading in the cryptocurrencies is purely due to speculative demand. So it was largely ignored until there was a realization that, well, does it really make sense that we're using paper currency 20 years from now? I don't think so. Like books have transitioned to digital, all this stuff. So it kind of made sense that we needed to go digital. Plus, the infrastructure of our system was just so antiquated that that something had to be done. And then a couple of other realizations occurred. Well, if we had a digital currency, then we could efficiently collect a value-added tax. So value-added taxes are so large right now because many people just use the cash currency to avoid them. But if you take the cash currency away, then you can efficiently implement a value-added tax and a border adjustment tax. So all that's kind of interesting. And then you think about instant monetary policy. So with a line of code, you can do a helicopter drop of money into everybody's wallet. And then people start thinking about zero or negative interest rates. A negative interest rate, you can only go so far, because at some point, people say, well, why should I put my money in a bank and lose 2% a year when I can just hold the cash at zero? So then they sort of get interested, but then there's another realization. And it's very similar to what we talked about earlier, that money has been redefined. So remember I said that you've got the wallet and you've got the choice of how you want to spend. And maybe one of those tokens is a token that's linked to the national currency, or maybe not. Maybe it's linked to the US dollar, which is not your national currency. So the central banks realized that, oh, well, we are at risk of losing control of money. In my opinion, they've already lost control and they're too late. And there's very limited number of things that actually can be done at this point. So in my opinion, China will implement a central bank digital currency, and they'll do it because they can. So privacy is a different sort of story in China than it is in literally the rest of the world. So the specter of a central bank digital currency seeing every single transaction that citizens make, that to me is unacceptable in the US, and it doesn't matter what your political leaning actually is. And the specter of the government having complete control. So this is not a decentralized blockchain-based idea. These are ledgers that are controlled by the government. So remember I said with blockchain technology, a key foundational feature is once it's in the blockchain, it exists forever. You can't alter it. Well, with these central bank digital currencies, it's not blockchain based, and the government decides what to do with the transactions. And if they don't like you, they can literally take all of your money. So a tax of 100% with a line of code. So I think that it's a real long shot that the central bank digital currencies make a lot of headway, at least in the US, over the next 10 years. There's also hybrid models, many different models here. There's some models that preserve some anonymity, people trying to work them out, but by the time they work them out, it's just too late because these already exist. Indeed, think about, and this is kind of an interesting example, think about a country in South America, which I'm not going to name, and suppose that country's got 700% inflation, which if you're rich in that country is annoying, but only annoying because you've got a bank account in Miami in US dollars. But if you're not rich, you get hammered by this 700% inflation. And you don't have the means to establish a bank account in US dollars in Florida. So again, think of this technology. So the rich have basically got around the central bank by dollarizing their wealth. But now the people that aren't rich, but have a smartphone, can have on their smartphone US dollar a token. Okay, so if you really think about what's happened, that you can effectively disintermediate the central bank. And the central bank these central banks will try to make things difficult. And of course, there's risks involved here. But I think it's a game they're going to lose. Because it just makes sense that we should have a broader view of money. It's not just the fiat, that it's so intuitive that we can tokenize. So if I really want a gold standard, I can do that. I've got a gold coin. So it's feasible to actually do that. So El Salvador, just let me briefly mention, they, as you know, they're already dollarized. So what's the deal here? And I think it was mainly a proof of concept that something like this could work when it's rolled out on a large scale basis. And it's a small country also, which helps if you're going to do an experiment. So I think that it's interesting, but I also think that it's much too narrow using Bitcoin, which is a very volatile cryptocurrency. So the volatile nature of Bitcoin, think of it as 6 times more variable than gold, or 6 times more variable than the S&P 500. So there's other ways to do this with more stable coins that might make more sense. But nevertheless, I think that it's an interesting experiment. Is it the future for all countries? No. And maybe it was easy for El Salvador to do this because they've already given up control of their money. They've delegated that to the Federal Reserve in the US. And again, other countries can do effectively, the people within the country can do the same thing. That if they want to dollarize, it's easy to actually do that. So overall, the central bank digital currencies, we're going to hear a lot about this. They are solving some problems. I will admit to that, but they've lost their monopoly. There's healthy competition. Indeed, the last thing I will say, this is kind of interesting, that while the US is actually considering what to do, we have all of these stable coins already in the US. So we've already got a digital dollar. So for example, Circle is the company behind a coin called USDC, so US dollar coin. And one issue that they've got is, well, it's dollar for dollar. You send a dollar, they give you the token, but then what do you do with those dollars? So you could buy some treasury bills, you could maybe deposit those dollars in a bank, but the bank is risky. The bank could go bankrupt like Lehman Brothers did. So how do you deal with that? So Circle has actually applied to become what's known as a narrow bank. And most of the people online know what that is, but let me just, for those that don't, a regular bank, you deposit dollars, let's say $100, and then the bank takes 10% or $10 and puts it as a required reserve at the Federal Reserve. And then the other 90, you lend out and make some money. With a narrow bank, if you deposit the $100, $100 goes to the Federal Reserve as both a required reserve and a excess reserve. And there's a small interest rate on the excess reserves. So that's what Circle wants to do. The Fed is not going to support this, I'm sure, because effectively what they would do is a de facto US central bank digital currency, because the Fed is effectively guaranteeing it. So even without going through all of the process, this can happen very quickly. And again, we've already got these US dollar digital currencies. So your question, or the series of 7 questions, I just want to emphasize that there will be resistance. So the commercial banks will resist. They need as much time as possible. They know what's going to happen. So they can see this. They're just buying time. The central banks, I think some of them, or at least groups within these central banks, understand the existential risk that they face. And they start telling stories about, oh, well, what about these central banks are really good at risk management, that if there's a problem in the economy, the central bank comes in and provides liquidity and stuff like that. And I'm just shaking my head because it's just evidence that they don't understand. So in the global financial crisis, the commercial banks were levered 50 to 1 or 100 to 1. Lehman Brothers was. So even the smallest change could wipe out all of your capital. And the regulators had no idea what was going on. In decentralized finance today, the borrowing is collateralized. You're not going to get 100 to 1 leverage. So it basically is a technology that mitigates a lot of the risks that are inherent in our current system. In the US, I deposit dollars at my bank. My bank sends some of those dollars to the Federal Reserve as a required reserve, but then the bank can use that as collateral for borrowing and use it collateral for levered borrowing. And if things go well, that's great. They get their payoff. If things don't go well, then they basically go to the Fed or the Treasury and ask for a bailout. And people will say to me, oh, well, yes, we know that happened in the global financial crisis, but all of that money was paid back. And that's a false argument because it doesn't include all of the millions of people that were unemployed and their lives disrupted by severe recession. So I actually would argue that the world of decentralized finance has got stabilization mechanisms built into it, where this sort of stuff is less likely to occur. So it's not like the bank being audited once a year by the FDIC or whatever regulator. The audit can happen in real time. You can see everything. It's completely transparent. And that's what we need.
I see. Well, Cam, I mean, we went past our time. I could spend another couple hours with you, and I'm sure that our audience as well. Just so many fascinating things, and yet so little time. So it's been a great pleasure speaking with you, Cam, today about your book. And we would like to express our gratitude to Paul Younes for his assistance in bringing him to our audience today. It's been a great pleasure, and we owe you a debt of gratitude on behalf of FLAR, our audience, and Latin America as a whole. So thank you so much, Cam.
Well, thank you for inviting me.
Este evento contará con una plataforma dedicada a la transmisión en vivo. Entrando a la página web del evento, eventos.flar.net, podrá encontrar los auditorios de las sesiones en vivo. Una vez en el auditorio, podrá ver la sesión en vivo, participar en el chat y ver información de la sesión, así como la biografía de los conferencistas. Si tiene dudas sobre la usabilidad de la plataforma, puede escribir un correo a comunicaciones@flar.net.
Hello, everybody, and welcome to the fourth session of our conference of central banks and official institutions. My name is Mario Acosta. I am the head of investments at the Latin American Research Fund. And this session is about a very current topic, which is the future of work. And it is a very current topic because the COVID-19 pandemic changed a lot the way we work. We had a forced experiment into remote work, which actually worked pretty good, right? It accelerated our adoption of new technologies, and more importantly, it proved that we can be productive working remotely. In fact, most of us are still working remotely, and many of the institutions and companies where we work, they are still trying to figure out what kind of model they will implement in the after pandemic world. Will it be go back to the office exactly as we used to? Will we remain at home? Something in between? We just don't know. And this is the reason why we invited our next guest, Professor Robert Posen, who is the author of the book, Remote Inc., How to Thrive at Work, Wherever You Are, which is a guide to thriving and excelling when working remotely if you adopt the mindset, habits, and technology tools of professionals who are even more productive outside the office. And in his own words, it's like learning to think like a company of one. Bob is currently a senior lecturer at MIT Sloan School of Management and a non-resident senior fellow at the Brookings Institution. And also, Bob knows very well the asset management industry. Back in 2004, he became the executive chairman of MFS Investment Management. And prior to joining MFS, he was vice chairman of Fidelity Investments and president of Fidelity Management and Research Company. So we will be able not only to talk about the future of work in general, but we will also talk about the future of work in the asset management industry, which is something I'm sure you all want to hear about. Bob is also the author of the bestseller, Extreme Productivity, Boost Your Results, Reduce Your Hours. And this year, as mentioned, he just published Remote Inc., his book about productivity when working remotely, which is the subject that we will cover during this session. So Bob, with no more introduction words, thanks a lot for joining us today, and it is a great pleasure to have you with us.
Thank you for inviting me, Mario. It's a great pleasure for me to participate here.
Great. Bob, preparing for this session, I was looking at a survey that was done by the CFA Institute and to investment professionals all around the world. And when they asked the question, what percentage of time is needed in the office for maximum productivity, CEOs and C-level executives, their answers were close to 55% time at the office for maximum productivity. But when they asked their employees, their answers were between 35 to 45% of the time. And every time you check a survey about this subject, you keep finding this gap, right? Many CEOs want employees to come back to work close to full time, but that's not the view of most employees. Why is that? What accounts for these big differences in opinion?
Well, when you speak to CEOs about why they want people to come back near full time, they name a few things. One is they feel like young people learn through the apprenticeship model, and that requires people, in their view, to be present and then to watch how others operate. A second thing they think is that being in person is really critical for innovation, for informal brainstorming, these sorts of things. And third of all, I've heard many of them say they feel like if people don't come back in person for most of the time, then they'll lose their company culture. Now, all of these 3 points, I think, have a measure of validity. But the question is, does it really require that you come back 4 or 5 days a week? And I think the answer is probably no. I think that many of these goals, many of these characteristics, many of these features can be achieved by being in person for some of the time, maybe 2 days or 3 days a week. So, if you are in the office several days, 2 or 3 days, you could have brainstorming sessions during that time. And then people can watch other people work, and you also have a sense of culture. I think the CEOs are also underestimating how much you can do this remotely. So people have been creative about having brainstorming sessions on Zoom. They use whiteboards on Zoom, and they can say that any member of the team can call a brainstorming session. They can sort of promote chit chat before and after meetings. So there are lots of ways in which you could have brainstorming remotely. So I think this gap is very real, but I think both sides need to compromise, and we need to think harder about what we're really trying to achieve by in person. How many days a week does that imply in person? And then how much of this can be accomplished remotely?
So let's talk about a little bit about this model. And for sure, the pandemic was the greatest experiment of remote work in our history. And we definitely learned a lot. Or at least we proved that remote work works, right? And although the pandemic is not over yet, some companies already implemented their new workplace structure, but many of them are still in that process. So in your opinion, what is the likely structure of workplace of the future? Mainly at the office, mainly at home, or something in between?
I think the answer is a hybrid in which you're at the office 2 or 3 days a week and you're at home 2 or 3 days a week. And yes, there'll be some companies that will go mainly remote, but that will be a minority, and there'll be other companies that will be mainly in the office. But it's the hybrid structure that really is, I think, going to be most popular, and is going to really be prevalent. And I think that's what we're seeing already, and we'll see more of it.
And who should be the one that decides that? Because we already saw the difference in opinions between the ones that are leading the company and the employees that work at it, right? And with the leaders biased to go back to the office and employees biased to remain at home. And so having those biases in mind, who should determine the optimal design of the hybrid structure, the organization or the individual employee?
Well, in my view, it's neither the CEO for the whole organization, nor should this decision be left up to every individual. I think that the relevant decision-making unit is the team. So if you look at most organizations, they're composed of teams that operate very differently. Let's look at an investment operation. So there are analysts who have their teams. There are IT support people. Those are a very different team. You have marketing people who are trying to reach the customers, and then you have, say, service and support teams for the customer. So those are just some illustrations of the different types of teams. And the different teams will have very different needs. And we shouldn't try to have one rule be the right answer for the whole organization. What I think we want is for each team to decide what's the optimal configuration, what we call in the book, the Goldilocks Plan, not too much remote work and not too little. And if that's done by the team leader together with discussions with the team, then I think that's going to have the best results.
Yeah, and that's an interesting concept that you have in your book, that basically in designing the hybrid model, one size does not fit all, right? And as you mentioned, one thing is the office needs of a portfolio manager, and something very different could be the office needs of the middle office, back office, the research department, or human
Right. It's totally different. Then you have the people who write software, or the people who support the hardware, people talk to the customers. So each of these teams is so different that the idea that you're going to have one size fits all doesn't make any sense. So we want to let each team make the decision for the team. And that's the relevant decision-making unit.
And what are the key factors that each team should consider in designing their hybrid?
Yeah, so my co-author and I wrote an article in the New York Times in which we coined an acronym, FLOCS, FLOCS, and that sort of encapsulates the key factors. So the first one is function, and that's by far the most important. So it depends on what you're doing. If you're doing something that requires a lot of collaborative work, that's very complicated, that requires fine negotiation, well, those are functions that tend to be done best in the office. But if you have work that involves extensive concentration for long periods of time, like writing code or these sorts of things, so those functions may be done better at home. So we really need to think first about what are the functions of the group, and what if we think hard about them, which ones are done better at home and which one in the office. The second is location. So if you have a group, a team that's located where people live around one metropolitan area, then it's easier for them to come in and to get together. But if the team is scattered throughout the country or throughout the world, well, then it's going to be much more difficult for them to come in the office. So I've seen teams that say, okay, they're national teams, but 1 week every month, the senior management team is going to be in one place, or you can have a global team meet together 2 or 3 times a year. So that's the location factor. The third thing is organization. So how interdependent are these teams? How are they configured in the organization? To the extent they're interdependent, then we want them coming into the office on the same time. But they may be very independent, and that may be unnecessary. A fourth factor is culture. Now that's the squishiest factor, and it's hard to come to grips with, but I think it's pretty clear that we need to think about how you can promote culture. We've been in an unusual situation because people know each other, then the pandemic came, so they've already built up some social capital. But when you get new people in the team and there's more turnover, well, then the question of onboarding people and how you get and maintain culture becomes critical. And the last factor, S, is for scheduling. So this is the practicalities that if you're going to have people on the team come in the office, you want them all to come in on the same day. You don't want them coming in on different days. And then I like to see people have a real space in the office that they can call their own. So some companies have done what they call hot desking, where people come in and pick a desk any place. But I think that's not really good. People don't have any place to keep their stuff, and every time they come in, they have to learn a different environment. So it's very disconcerting. So if you have two teams, for instance, that rotate through the same space, then everybody can have their own office, even if they share it with someone else. And also from the organization's point of view, you can probably reduce the rent by 30 or 40% if you do that. So those are the 5 factors that we want people to consider as the team designs what's their optimal hybrid.
And Bob, let me go deeper in one of the flux factors. Let's talk about culture. And probably one of the main issues about remote work is that it is much harder to establish relationships with your coworkers and colleagues, right? Because there are no elevator chats or going out to grab some lunch or those spontaneous personal interactions that help you build confidence with your team and your coworkers. And probably it is even harder to relate with your boss under this model. So to the extent that employees are working remotely, how should they change the way they relate to each other and to their bosses?
Well, I think it probably is clear now that the managers have to be more proactive to promote these values, the culture. And if they're working remotely, one of the things they can do is hold meetings where there's no business agenda, where the point of the meeting is for people to talk about what they did in the last month, about what's happening with their children, what's happening with their hobbies. And people have become pretty creative about it. People have played games together with their groups. People have had cooking lessons where they deliver food to each person and then they cook together. So that's really important in terms of building culture, is having these non-business remote meetings. And then another thing is that I hate it when people have meetings scheduled back to back, every hour on the hour, and they just go from one meeting to another. So then there's no time for informal discussion, no time for chit chat. So I really think one of the rules that a team should set forth is that no meeting occurs more than 30 or 40 minutes. And so that gives people a chance before or after the meeting to have the sort of personal talk and other things that maintain culture. And I think in terms of relationship with your boss, we hear a lot of remote workers worry about that if they're not physically present, they won't have the boss's ear. Well, I think I like to see people, bosses, team managers, hold one-on-ones every week with their direct reports, so that if they're working remotely, they still have that time dedicated to talking to their boss and having building a relationship with him or her.
And let's go deeper on that other side of the coin, the managers, because many managers faced the pandemic having no idea about how to lead a remote team, right? They were not trained for that, and for sure it was quite a challenge for most of them during the pandemic. So in managing a team that is partly or fully remote, what strategies should an effective manager adopt?
Yeah, so to begin with, I think managers of remote teams need to set what I call ground rules for the team. A lot of people have complained to me when they're working remotely, they feel they're on 24/7, they don't know where the boundary is, and they burn out if that happens. So the manager of the team can set ground rules like, we expect you to be on to answer emails or the Slack channel, but not after 7 p.m. or not in the weekends. So that's an important thing. Another practice is what I just said about meetings, that meetings should only take 30 or 40 minutes. So there's time for chit chat. And I think people need to understand when the team should be using email, when they should be using the Slack channel. And there can be really helpful ground rules on that. So I think these are some of the practices. Plus, I think every team needs to have a weekly meeting, but that meeting needs to be forward-looking rather than backward-looking. Sometimes I've seen these weekly meetings where people basically report on what they've done in the prior week. Well, that can be done more efficiently through email or a Slack channel. It doesn't have to be done in person. The type of weekly meeting I'm thinking about is one where people talk about, well, what's their agenda for the week ahead? And then they try to get input from people as to, how they could do this better, ideas, contacts, these sorts of things. So those sorts of weekly meetings are very important. And as I said, we also want to see managers have one-on-ones with their direct reports. People are feeling isolated when they're working remotely, and we want to overcome that. And if some of the workers are remote and some of them are in the office, then the meeting should be conducted as if they're all remote, because otherwise the people in the office will feel like they have a leg up, and the people who are in the remote setting will think of themselves as second-class citizens. So those are some of the practices that we want to see managers doing. And, if managers want people to come back to the office, they have to make it more attractive. They have to make sure that health protocols are there so people feel safe. They need to give them decent space so people are interested in better space now, more space, more meeting rooms, more things like that. And if you want people to come back to the office, also got to make it more fun, the collaboration side, to actually have more collaboration, more collaborative type of activities. So those are some of the things that would be involved with proactive management.
And Bob, you just mentioned meetings, and I think that's a very sensitive topic in this debate, right? It always comes out when you are talking about implementing hybrid models, and it actually is one of the strongest arguments for the promoters of full-time office work, that collaboration and interaction between coworkers is much better when they are physically together compared to video meetings. And to some extent, I agree. I think that meetings at the office work very well. I also think that meetings, when everybody is connected remotely, they also work pretty well. But I have my doubts in hybrid meetings where some people are present at the office and others are connected to the meeting remotely, because the ones that are remote, they might lose some of the dynamics and the interactions of the people that is present in the room. So what are the best practices in terms of running meetings that are all or partly remote?
Well, if you have a meeting you're talking about a meeting in which some people are in the office and some people are at home, I think that meeting has to be conducted as if it's fully remote. Otherwise, the people who are remote will feel like second-class citizens and they'll be left out. But I think more generally, you're right to say that the pandemic has shown that we really need to be a lot more disciplined and rigorous about our meeting practices. So I'd like to divide it up to before, during, and at the end of meetings. So before meetings, a lot of bad meetings are because there's no preparation. We want to have people circulate an agenda in advance and then circulate background materials if there are going to be background materials, and there should be in most cases, 24 hours ahead of time. So if people get invited to a meeting, but there's no agenda, they should ask for one. And if they don't get one, they should consider not going. People always ask me, how do we avoid going to so many meetings? Well, if you ask for an agenda, that's a good way. Some people won't give you an agenda, and other people will give you an agenda and will show that this really isn't a high priority for you. So you can say, look, I can now see what the meeting's about, and I'll catch up with you later because I don't think I really want to spend this much time at the meeting. And the other thing that happens is when you have video meetings, people have a tendency to invite anybody and everybody because there's no physical constraint. But there's been a lot of work on what makes for a good meeting in terms of size, and it's usually in the 6 to 8 people range. Once you get these very large meetings with 14, 18, 20 people, there's a lot of social loafing so that people don't really participate very well. Then if we look at what happens during the meeting, one of the things that I want to insist on is that people have videos on and not have some sort of avatar. Otherwise, you can't really tell whether they're participating or not. You can't really see their body language. So it's pretty difficult. So when you have an online meeting, you want the leader to start by teeing up the issues, but not to take more than 10 minutes. If the leader reviews all the materials that have been sent out, it often takes 30 or 40 minutes, and then nobody has an incentive to read those materials because the leader is doing it. It's also pretty boring. We see lots of people who have lots of PowerPoint, and they just spend most of the time having PowerPoint. Well, what's the point of the meeting? The point of the meeting, of a lot of meetings, is to have discussion and debate, to have the innovative brainstorming. So if you're hearing the leader drone on and on, well, that's a big mistake. The leader should have 10 minutes and then provoke through questioning and structuring a good discussion or debate. Or alternatively, some meetings are more what I call process meetings. So they're there to build team spirit or to have morale and celebrate wins, these sorts of things. Well, again, having someone stand up and do PowerPoint for a long time doesn't really do it. I want to see the leader be proactive in getting people involved. Maybe he or she should ask someone who's a junior person what they think and start the conversation, because if you let the senior people dominate, then the junior people may be afraid to talk. The last thing is what happens at the end of the meeting. So we've all been at meetings which end and no one quite knows what's been decided and where it is, and just leaves up in the air. And in remote meetings, you can't really press this as you're walking out because it's hard to do. So we really need to have good closure. So good closure means let's have a summary of what we've decided. I'd like to see it put in some sort of minutes that allows people who are not at the meeting to know what happened, and then reduces confusion about what's actually been decided. And then next steps. What are the next steps? Somebody has to ask that question. What are the next steps? Who has responsibility for the next steps? And what's the time frame for the next steps? So those are some of the best practices before, during, and after a meeting, and at the end of the meeting, but they're violated all the time. That's why a lot of meetings are pretty boring and unproductive, and that's why a lot of meetings just don't really go anywhere. But it's a solvable problem if they're managed well. So these are pretty simple and straightforward rules that can be followed to get better meetings.
Totally agree. And let's talk a little bit more about that interaction between leaders and the team. And we already saw the difference in opinions about going back to the office between the two groups. And I believe that part of the reason why leaders tend to prefer their employees to go back to the office is because that makes them feel like they have more control on the outcome of their jobs, because they can check on their tasks more frequently, or they just can look to each other the whole time at the office. And this is changing with remote work, and probably during the pandemic, this was a big challenge for many leaders that were used to the old model of a full-time office job. So this is where in your book you introduced the concept of success metrics, right? So can you please tell us a little bit more about the characteristics?
Let's take a step back. So I think you're right that a lot of bosses, in remote work, get a little nervous because they don't have the control. They can't just walk around the office and see where everybody is. Some companies have actually put software in so that they can monitor how much time you're on your phone or how much time you're on your computer. So I'm really against all that. That's crazy. So instead, what we preach in the book is a whole different model and a whole different mindset about how remote workers ought to think of themselves. And that's where we think of like a business of one, that you have your own skills, you own your time, you own your place. And so it's like you're running a small business, and that implies a very different relationship with your boss. So your boss isn't there to tell you every day or every hour, do this, do that. You want to agree with your boss on a set of deliverables, what you're going to do with it by the end of the project or the end of the week or the month, whatever is the relevant time frame. And then once you have these deliverables agreed, then the boss can back off and you can figure out how to deliver these, when and where and the most efficiently. So it's like your boss is more your client than the direct dictator and, authority figure. Now, people say to me, how does this, how do you actually implement this? It's a great concept, but how do you implement it? And that's where success metrics come in. So when the boss is thinking with the team, well, what are we going to do this week or on this project or this month? I want the boss to say, okay, how are we going to know whether we're successful at the end of this period? So we want to come up with success metrics. The boss is setting the objectives because the boss is tied into the organization better and knows what needs to be accomplished. But then it's up to the team and the boss to negotiate on what are going to be the success metrics. And the better designed they are, the better it is for everybody. So then once you have success metrics with specific timeframes, then it has huge positive effects. First of all, it clarifies what we mean by these objectives. Lots of times when a boss sets objectives, the people have very different views of what that actually means. I run a executive course for executives, and I asked them, well, supposing the objective was to improve customer service. So everybody wants to improve customer service, but people have very different views of what that means. Some people think about customer satisfaction like a survey. Other people think about objective things like getting deliveries on time, high degree of accuracy, and there are a myriad of different views. So by taking an objective and translating it into success metrics, there's a clarification for everybody about what needs to be done. Second of all, for the boss, once he or she knows there are these success metrics, hopefully it helps them delegate more and not micromanagement, because then they know what's going to come out at the end. So they don't have to be on the employee's case every day saying, are you doing this or that? They know what's supposed to come out at the end. And third, and probably most importantly, this autonomy that we're giving workers, we've proved time and time again that that's the key to their job satisfaction and also to their productivity. When they have the autonomy to control when and where and how they work, that's what produces these good results in terms of job satisfaction and in terms of productivity. So as you can see, I'm a big fan of success metrics. It takes this whole model and makes it workable. And I think it's really something that every remote group ought to implement.
And there's something very interesting in your work about success metrics, because success metrics imply periodic evaluations of your team, right? But I found that you're actually very critical with annual performance reviews, right? So
Yeah, well,
why do you think?
I'm like president of the Anti-Annual Performance Review Club.
Yeah.
I invite you all to join me. So those tend to be very formalistic. Usually they're pretty stale because a lot of it's already happened, and they're not very useful. They're not very constructive. In many organizations, people only get good grades and then, or they get fired and there's nothing in between. So that doesn't make much sense. So what I want to see is periodic performance feedback. And that should be based on the success metrics that we've just talked about. So after every large project, you can say, well, here are our success metrics. Did we achieve them? If we did, great. Let's celebrate. If we didn't, let's understand why and try to prevent those things from happening again. So I like to see periodic performance feedback, at least once a quarter, and not waiting until the end of the year to have this big formal review.
Great. And changing subject and talking about the careers. One phrase I have heard a lot lately after the pandemic, and probably you've heard it too, is that if you want to have a job, working from home is fine. But if you want to have a career, you should go back to the office. And this talks about the relationship between managers and employees.
No, you're right. A lot of people working remotely are very fearful about what's going to happen with their career. They think they're not going to be able to get, they're not going to know of opportunities that are happening. They're not going to have a relationship with their boss. So they're going to be left out. So I think when you're managing people who are working remotely, you again have to be proactive and bring up this idea of career planning at least once, if not twice a year, and discuss with people, well, what is it that they want to really get to in 2 or 3 years? I don't believe in going out 10 and 20 years because it's too far, but you can have a really good discussion about the next 2 or 3 years. And, you know, managers can help. What can they do? They can help people by subsidizing courses if they think they need new skills. They can help their teams by giving them opportunities to work with people in other parts of the company so they can see things. They can encourage people to join industry groups. So these are all the sorts of things that managers can do to help their team members feel like they care about their careers, and they're also helping them to progress.
Great, Bob. And now I have to take advantage of your experience in the asset management world. As promised, as mentioned, you had leading roles both at MFS and Fidelity. And I'm sure the audience want to hear your thoughts about the future of work in the industry. And my first question is actually related with one of the flux factors that you mentioned before, which is location, right? And historically, the asset management industry has been very concentrated in a few financial hubs like New York, London, and a few others. Do you think this would change with the adoption of remote work? And if that's the case, what kind of asset managers would outperform in this new environment?
I'm not sure we can figure out who's going to outperform. But I think we can say that this skill set that is going to be necessary for asset manager is changing. And there's going to be a lot more emphasis on non-traditional sources of data and people who can analyze that data, so that the role of data scientists will be greater. Now, some people, you know, my students sometimes say, so you mean there are going to be no people left and asset management will all be done by algorithms, computers? Well, I think that's definitely not going to happen, because even if we have non-traditional data and then we analyze it, there's always going to be a judgment call about what it is that you're going to do with this data. And the idea that somehow AI is going to come up with all the answers is just not feasible. So those people who deal with data, they can really be located anywhere. But the people who are making the judgment calls, the portfolio managers, the senior analysts, I think they still have to be located in concentrated areas. Now, it doesn't have to be in one city, but you could have somebody in Boston and somebody in London and somebody in Tokyo. But I think those interactions are really important. And the other thing that happens is if you're at a place like Fidelity, lots of CEOs come to your offices and make presentations about what's going on. Now, of course, this can be done remotely, but what you're really trying to do when you see these CEOs is you're making a judgment, not just about what they say, but what sort of person they are and whether they really have leadership ability and whether you really believe what they're saying. And I think also if they come back year after year, there's a degree of accountability, personal accountability, if they don't deliver. So I think we will see more data scientists and data gatherers and people who are skilled at algorithms, and those people in the asset management industry, those people can be located pretty much anywhere. But I still think you'll have hubs for any company and any asset manager in a few places, maybe a little more, but I think that personal interaction, both with other analysts in your own company and with CEOs, is really still going to be important.
Right. And now let's talk about them, the people, because the disruption of technology has had a significant impact in the human capital of the investment management industry. And remote work is just an example of that, right? Asset managers now, as you mentioned, have access to a larger pool of talent just because of technology, just because of remote work. But technology is also affecting the profile of people that work in asset management because of automatization, artificial intelligence, robot advisory, you name it. What kind of skill sets or profiles are likely to do well or do poorly in the coming years for current and newcomers of the asset management industry?
We like to think that the profile is all the students coming out of the MBA programs at MIT Sloan, because we teach them, they learn a lot about quantitative methods, they learn a lot about data analytics, they learn a lot about these things. So I think there's a shift, and that data scientists will be sought after by asset managers, and people who understand algorithms will be sought after, and that's changing the composition. But people still, if you have AI algorithm, etc. Let's assume, for instance, that your algorithm predicted accurately that Donald Trump would win the 2016 election. But then the question is, what's your investment thesis on that? Some people would say, well, if he won, the markets were going to react adversely, but that didn't happen. And so there's always going to be a judgment call. There's no substitute for common sense and judgment. So I think that the firms that are going to be successful are the ones that are good at melding these two different sources of decision making. One is the data heavy algorithms that are going to sort through all this stuff and maybe create universes or hypotheses for you. But then we still need the judgment calls as to what's going to happen and what you're going to invest in on the basis of all that. And that's something that is not really amenable to an algorithm, in my view.
Well, we still have a couple of minutes to take questions from the audience. And one question that we got is related with one of the topics we mentioned before, which is meetings and the specific issue of cameras off during those meetings. How can we, either the leaders or the employees of the organization, encourage the use of cameras during the meetings without invading people's privacy on this?
Well, one way to do it is to have give people virtual backgrounds like the ones we're both using now. So people's privacy would be if they're at home and they feel like they don't want to show everybody what's in their kitchen or what's in their bedroom. So if you make it easy for people to have virtual backgrounds, then they can come on. The second thing is to subsidize technology for people to give them good cameras and things where they feel like they're able to present themselves. And I think that people need to understand that when they don't have their cameras on, it's really hard for everybody else to see how they're reacting, how they're feeling about what's going on. So there's some degree of education about that. But I think if we have a virtual background, it's hard to think about where the privacy issues and those things, they tend to fade away. So I'm a big fan of virtual backgrounds, but I'm also a fan of cameras that show not just your face, but some part of your body.
Mm-hmm. Great. And another question that is related with one of the subjects we mentioned before is how being able to recruit globally instead of just locally or regionally without necessarily requiring them to move to headquarters. Is that a significant competitive advantage? And this is related also with is that an advantage for the worker as well? Because yes, you have access to many companies around the world, but you are also competing now to many other people around the world. Who is the winner in this new dynamic?
Well, I think people who are highly sought after will have an ability to locate where they want. And most companies are going to have to provide at least one site other than headquarters where they'll be able to work. But as I said, I think it's better for the worker, the professional, and better for the company if it's not like 20 cities, it's a cluster, so maybe 2 or 3. And I think the difficulty is if you join a company, let's say where Boston is the headquarters as an asset manager, and you're managing mainly looking at Asian stocks. So it's perfectly reasonable for you to be in Singapore, and that might be a better location for you to see companies and CEOs. But I think it's really important that you spend some time at headquarters at the beginning so that you meet the people who are running the firm, you observe the culture, and you can sort of see how things go. So I think that onboarding process is really important for you. The other thing is it's important that, when I used to be president of Fidelity Management, I used to go to all the offices at least 4 times a year. And I think it's important for the people who are the top people to be doing that so that they can hear what are the issues, what are the concerns, they can see them and make these people feel that they're really part of the organization. They're not just, a hired gun out there. So I think those are some of the things that I would like to see.
Bob, any final advice for those leaders that are watching us right now and which are still deciding what kind of model should they implement in their companies or institutions in the after pandemic world?
Well, probably my final advice is to try to see this whole new world of hybrid. And as I said, I think companies will be hybrid as sort of a beta test, an experiment. the reality is that we're just figuring out these new modes of work. And as I said, I think everybody will be hybrid, but exactly what that means, how that design comes about, and whether it will be 2 days or 3 days, whether it will be in satellite offices or other offices, that's all up for grabs. So I think the key is to come up with, on a team basis, the optimal, what you think is going to be the optimal hybrid, and then try it out for 6 months or a year. But don't view it as like, this is the way it's going to be for the next 5 or 10 years, because we really don't know how these things are going to work. And at the end of 3 months and 6 months, 9 months, you ought to sort of reevaluate whatever design you come up with the hybrid. And so that also implies you ought not to make irreversible decisions. So you ought not to buy a large building because you decide that's what you want, because a year from now, you might not think that that's the best way to go about it. So I would say, do the best you can to design your hybrid using the 5 factors and other things we've talked about. But second of all, view this as a beta, as an experiment, and reevaluate at least in 6 months, if not sooner. And third of all, try to not make irreversible decisions, which would be impossible to change or incredibly costly to change if you change your hybrid, because this is all, it's a new world, and we're learning every day. And let's face it, the other big question mark is what's going to happen with COVID. How is it that we're going to be dealing with that? Are we all going to get immunized, and we're going to learn how to do this and not going to have to worry about it again? Or is this going to be a continual fight? So we don't know the answers to these questions. So we don't want to come up with a hybrid and say, okay, this is the answer for the next 5 years. We want to avoid that.
Well, again, thanks a lot. It was very interesting, your session. I definitely enjoyed it, and thanks a lot for joining us this time.
Well, thank you, Mario. I appreciate the thoughtfulness of your questions, and hopefully the audience will have learned something about this in the process. And I appreciate your mentioning my book, Remote Incorporated. So that's easily available on Amazon. And my other book, Extreme Productivity, just came out in paperback. So that's been, I think it is translated into both Portuguese and Spanish. So people can read it in those languages if they want. So thanks for having me, and good luck on the rest of your conference.
No, thank you. And about your book, Remote Inc., for the audience, remember that you can participate for a copy of it. For this book and all the other books we have covered during the conference, just follow the instructions below the chat. You will see there how to participate to win one copy of Bob's book, Remote Inc. And also remember that on Tuesday, we will continue with the conference. We will have at 10 a.m. Eastern time, our session about the future of geopolitics with Marco Papic from Clock Tower Group. And then we'll have the session about the future of money with Edward Prasad from Cornell University. Thanks a lot, and we'll see you on the next time.
Take care. Thank you.